This is not a financial advice. Please, consult a licensed specialist before taking actions. While you're debating whether to put another 1,000 into your 401k, the ultra-wealthy just made a move that will reshape their entire financial future. And here's what nobody's talking about. They're doing something completely different than they were doing just 2 years ago. I'm not talking about the usual invest in real estate and index funds advice you've heard a million times. I'm talking about a massive shift happening right now in 2025 that has wealth managers scrambling and hedge funds completely changing their playbook. In fact, private equity, the investment class that dominated wealthy portfolios for over a decade, just got knocked off its throne. Family offices managing billions pulled back dramatically. Hedge fund allocations dropped to just 2% of ultra-wealthy portfolios, down from 12% 16 years ago. So what are they doing instead? And more importantly, why should you care even if you're not managing millions? Because these shifts reveal something crucial about where smart money sees the economy heading. Let's break this down. Here's what's actually happening right now in wealthy American portfolios. And I need you to understand, this isn't theory, this is hard data. From Goldman Sachs surveys of family offices managing over $1 billion each. Public equities, regular stocks just jumped to 31% of ultra-wealthy portfolios. That's a 3 percentage point increase in just 2 years. Meanwhile, private equity dropped from 26% to 21%. That's the biggest shift Goldman Sachs has seen in any asset class. But here's where it gets interesting. This isn't a retreat from risk. These families aren't getting conservative. According to Tony Pasquariello, Goldman's global head of hedge fund coverage, they're running what he calls a pro-risk asset mix. They're still heavily invested long, with 76% of their portfolios in real estate, public equity, and private equity combined. So if they're still bullish, why the rotation? 3 reasons nobody expected. First, liquidity. Private equity exits have dried up. Endowments and foundations have been trying to sell their private equity stakes and struggling. The ultra-wealthy saw an opportunity. While others were trapped, they could move. They redirected capital into markets where they could actually get their money out when they wanted. Second, they're hunting for dislocations. Mina Flynn from Goldman Sachs revealed that 72% of family offices are now investing in secondaries, buying private equity positions at a discount from desperate sellers. They're not abandoning private equity. They're just being opportunistic about how they enter. And third, the reason that changes everything for regular investors too, artificial intelligence. This is the part where things get wild. Because 86% of family offices surveyed said they're invested in AI in some capacity. And guess how most of them are doing it? Not through some exclusive Silicon Valley venture capital fund. Not through private deals with the next OpenAI. They're buying public equities and ETFs. The so-called Magnificent Seven: Apple, Microsoft, Amazon, Nvidia, Meta, Alphabet, and Tesla have given wealthy investors the kind of growth they used to only find in pre-IPO startups. Nvidia alone has created more wealth for public market investors in the past 2 years than most venture capital firms create in a decade. But here's what's really happening beneath the surface. According to Charles Schwab's 2025 Modern Wealth Survey, 72% of millennial and Gen Z investors believe it's no longer possible to achieve above-average returns solely through traditional stocks and bonds. They're right and wrong at the same time. They're right that the old 60/40 portfolio, 60% stocks, 40% bonds, doesn't work the same way anymore. In fact, 2/3 of Americans now believe investing success requires supplementing traditional investments with new asset types. But they're wrong about where the opportunity is. The opportunity isn't in chasing the next crypto moonshot or trying to get into exclusive private deals. It's in understanding which trends the mega wealthy are positioning for and participating in the same movement through accessible vehicles. Right now, wealthy investors are going hard on tech infrastructure, not just buying Nvidia, but investing in data centers, cloud computing companies, semiconductor supply chains, all available through public markets if you know where to look. And that brings us to something even more surprising about how the rich are investing in 2025. Remember when hedge funds were the ultimate status symbol for wealthy investors? When getting into a top fund meant you'd made it? That world is dead. Michael Sonnenfeld, founder of Tiger 21, a network of ultra-high net worth investors and entrepreneurs, put it bluntly. Hedge funds are dead as an investment class for the super rich. Tiger 21 members' allocation to hedge funds plummeted from 12% to just 2% over 16 years. And these aren't novice investors. These are people who built their wealth from scratch, averaging about 1 in 10,000 by accomplishment. So what happened? The honest answer is brutal. After fees, most hedge funds couldn't beat a simple index fund. When you're paying 2% management fees plus 20% of profits, you need exceptional returns just to break even against a low-cost S&P 500 ETF. But there's a deeper shift happening. The ultra-wealthy are moving toward direct investments, where they can leverage their own expertise. Jay Zigmond, a CFP who works with high-net-worth clients, recommends simple 3-fund portfolios: total U.S. stock market, international stocks, and bonds. Wait, that sounds too simple, right? The ultra-wealthy are using the same strategy financial advisors recommend to regular investors? Here's what's actually happening, and this is crucial. The wealthy are splitting their portfolios into 2 buckets. Bucket 1. Core holdings in broad market index funds and ETFs. Boring, tax-efficient, consistently compounding wealth. This is where most of their money lives. Bucket 2. Concentrated bets in areas where they have unique insight. Private equity deals in industries they know. Direct real estate investments where they see opportunity. Venture capital in sectors where they have connections. The ratio matters. According to Sam Dogan, founder of Financial Samurai, no single asset should exceed 50% of net worth. Homeowners should aim for real estate to represent just 25–30% by retirement. This is the opposite of what most people think wealthy investors do. They're not swinging for the fences with everything. They're building a fortress of steady returns, then taking calculated shots with a small portion. Now we get to the part that actually creates wealth or destroys it. Because wealthy Americans don't just invest differently. They structure everything differently from day one. And in 2025, the tax landscape just shifted in their favor in a massive way. The One Big Beautiful Bill just locked in tax changes that will save wealthy Americans millions. The top tax rate stays at 37% instead of reverting to 39.6%. The estate tax exemption increased to $15 million per person and $30 million for couples, up from $13.99 million. But here's what most people miss. The wealthy aren't just benefiting from lower rates. They're restructuring their entire financial lives around the tax code. Let me show you how this actually works. Charles Njoya, who spent 17 years at PricewaterhouseCoopers working with billionaires and major corporations, founded CHN Advisors to teach these strategies to high-income earners, making over $300,000. His core insight: the U.S. government owns nothing and relies on the private sector to build wealth. The tax system rewards those who contribute to building America. What does that actually mean? It means the tax code isn't designed to punish wealth. It's designed to incentivize specific behaviors. Real estate investment, business creation, job creation. When wealthy investors buy rental properties, they're not just collecting rent. They're taking depreciation deductions that create paper losses, offsetting their W-2 income. When they start businesses, they're using the pass-through deduction that can save 20% on qualified business income. The bonus depreciation rule, now permanent, lets businesses immediately deduct 100% of qualifying assets. Buy a private jet for business use? Full deduction in year 1. But the real wealth preservation happens through trusts. Grantor retained annuity trusts, spousal lifetime access trusts, intentionally defective grantor trusts. These aren't tax loopholes. They're vehicles explicitly created by Congress to facilitate intergenerational wealth transfer. The annual gift tax exclusion in 2025 is $19,000 per recipient. That means a wealthy couple with 3 children and 6 grandchildren can transfer $342,000 per year completely tax-free, every single year, forever. Over 20 years, that's $6.84 million moved to the next generation with 0 gift tax. Real estate just got knocked to second place in wealthy portfolios for the first time in 15 years. But here's what that headline misses. The ultra-wealthy aren't abandoning real estate. They're getting selective. At 26% of Tiger 21 member portfolios, real estate is still massive, but they're hunting for specific opportunities while avoiding others like the plague. What they're buying? Last-mile distribution centers, warehouses near major metro areas, properties that benefit from e-commerce growth, and residential conversions, buying struggling office buildings and converting them to apartments or hotels. What they're avoiding? Traditional office space, retail locations, anything that requires foot traffic in a world that's moved online. According to a 2025 LendingTree survey, 36% of Americans say homeownership is their primary wealth-building strategy. But the wealthy take a different approach. They view real estate as one tool among many, not the foundation of everything. Sam Dogan's advice about keeping real estate to 25–30% of net worth by retirement isn't about avoiding real estate, it's about risk management. Real estate is inherently illiquid. It's geographically concentrated. It requires active management or property manager fees. The wealthy diversify into REITs for exposure without concentration risk. They invest in real estate debt lending to developers rather than being developers. They buy stakes in syndicates where professionals handle the operations. But here's where individual investors miss the opportunity entirely. Regular investors see real estate as owning rental properties. The wealthy see real estate as a tax-advantaged income stream with multiple exit strategies. They're calculating after-tax returns, not pre-tax yields. They're structuring ownership through LLCs and trusts. They're planning depreciation schedules and 1,031 exchanges years in advance. So after diving through Goldman Sachs surveys, Tiger 21 allocations, and the actual strategies wealth advisors use with ultra-high net worth clients, what should you actually do? Because here's the truth. Most of you watching this aren't managing $30 million. You're trying to figure out what to do with $30,000 or $300,000 or maybe your first million. First, stop chasing complexity. The wealthy use index funds for their core holdings. You should too. A 3-fund portfolio of total market index funds works at every wealth level. It worked for building wealth, and it works for preserving it. Second, understand that alternatives are becoming accessible. According to Bain and Everest Group, alternative assets for private wealth investors will triple from $4 trillion to $12 trillion by 2034. Platforms are emerging that give regular investors access to private credit, private equity, and real estate deals that used to require $5 million minimum. But, and this is critical, don't chase alternatives until your foundation is solid. Alternatives are illiquid. You can't access your money when you need it. Build your emergency fund, max out tax-advantaged accounts, and establish your core portfolio first. Third, learn the tax code or hire someone who knows it. The difference between paying 37% on all your income and structuring your life to pay 20% long-term capital gains rates is generational wealth versus comfortable retirement. And finally, the biggest lesson from how the ultra-wealthy invest. Time horizon. These families aren't investing for the next quarter or the next year. They're building century-spanning wealth. When Goldman Sachs asked family offices about their positioning, they weren't hedging for a correction. They were making long-term strategic bets on where the world is heading. AI and technology infrastructure. Private credit to high-quality borrowers. Real estate in the right locations. All of it held for decades, not months. Warren Buffett's response to Jeff Bezos says it all. When asked why more people don't follow his simple investment approach, Buffett said, "Because no one wants to get rich slowly." The wealthy aren't doing anything magical. They're doing the boring work of consistent investing, tax optimization, and long-term thinking that most people simply won't do. The question isn't what the rich know that you don't. The question is what you're willing to do differently starting today. If this video changed how you think about investing, hit that subscribe button. I'm breaking down wealth-building strategies every week, translating what the ultra-wealthy do into action steps for regular investors. Drop a comment telling me which strategy you're implementing first. I read every single one. And if you want to go deeper, I've put together a free resource guide in the description with links to the research cited in this video. This is not a financial advice. Please, consult a licensed specialist before taking actions. Thanks for watching. Now go build your wealth.